So I'm sure you guys know by now ChatGPT and Google Bard, but did you know that the newest entrant in the space is actually Google Gemini, which is now replacing Google Bard? And they claim that this is the latest and greatest upgraded version of the AI large language model. So I thought, why not take it out for a spin and ask this AI what it thinks are the top 5 best stocks to invest in this year. Well, that's exactly what we're going to do in today's video, guys. And of course, you know that every time we do a video like this, I got to actually rank these stocks too from best to worst based on my opinion, because it just makes it a little more fun and interesting to do that as well. So let's not waste any time. We got 5 stocks to run through here. It's going to be a fun video and I can't wait to jump into it. So let's just go ahead and dig right in. All right, now first things first here, I gotta mention that I actually use the Ultra version of Gemini. I don't know how familiar you guys are with this platform, but basically when you go into the Gemini app, it gives you an option to upgrade to the Ultra version for $20 a month, which they claim is their most capable and state-of-the-art version. So I signed up for a 2-month trial to see how good it is, which took me over to the Gemini Ultra platform, and that's where I popped the question, what are the 5 best stocks to buy in 2024? Now, like most financial, health, political, religious, and other types of controversial topics out there, AI models will sometimes try to avoid your question if it feels like it's too close to professional advice or some type of bias that can make the company look bad in the future, with Gemini being no different, basically saying that it can't accurately predict the future and thus wants to avoid answering my question altogether. But with a little workaround, I was eventually able to get a full response by following up with, what criteria do you think makes up good stocks to invest in? To which it gave me a huge, really detailed response breaking down areas of financial strength, growth potential, valuation, and other factors. So then I followed up with, well, what are 5 stocks that you think best meet this criteria, and give me reasons why you think that. And so I also copied and pasted all of those metrics that it had listed before, and I did that word for word. To which it finally agreed to answer my original question with a list of 5 stocks that it thinks are the best according to its own criteria. So here we go. Let's run through these one by one. Well, starting with stock number 1, it gave us Costco, which is a little surprising here, but this is the retail giant that many people like to shop at, usually buying a ton of stuff in bulk for decent enough prices at their large warehouse-like stores or even online. With the stock itself seeing very strong performance, currently trading at an all-time high after rising by over 500% in the past 10 years. And so let's review each of these statements one by one and see if I agree with them. Well, first up here, for financial strength, Gemini says stable profitability with healthy EPS growth, manageable debt, and reliable free cash flow. And yeah, I mostly agree with that. The company has been growing their financials in most years, with last year in particular seeing gigantic sales of over $240 billion. The one criticism that I will make though is that their margins are pretty small, only sending about 3% to the bottom line. I guess it's somewhat okay because of their massive size, since even at that margin they still bring in billions in profit, but I don't know, 6 billion compared to more than 240 billion in sales just looks a little weak to me, but fair enough, I'll still give it that point to Gemini. Then for growth potential, the AI says steady revenue growth through consistent membership renewals and increasing store count. Well positioned in the discount retail space, relatively safe against recessions, strong customer loyalty acts as a competitive advantage. And this one is a little iffy for me because I think Gemini is kind of trying to hide the low growth here by saying that it's a strong business, which, yeah, of course it's a strong and relatively safe business. Costco is already the 3rd largest retailer in all of America, only behind Walmart and Amazon. Plus they have a growing online presence too. They have a pharmacy center, an optical center, an auto center, and lots more. You can pretty much get everything you need through Costco, and most people that sign up for the membership, which only costs around $60 a year for the base level, tend to keep it long term because at that price point, they really feel that they're getting their money's worth. So yeah, pretty strong business that will probably never go away, at least not anytime soon. However, this category is supposed to be about growth, and that's really where I mostly disagree with Gemini, as I just don't see a lot of future potential in a legacy retailer, at least not to the tune of something like Amazon, which is also more diversified. As such, Costco typically grows their revenue at mid-single digit rates at best, so I feel that really there are much better options in the market if you're specifically looking for growth. For valuation, though, the AI model says moderate PE ratio, not exceptionally cheap, but reflects market trust in Costco's business model, offers steadily increasing dividends, appealing to income seekers. But yeah, this is another scenario here where I feel that Gemini is kind of trying to mask a weak attribute by simply saying that the business is strong enough to make up for it. Obviously, a strong business will drive up the valuation, but when you're talking about a PE ratio that is over 100% more expensive than the sector, that's a very expensive stock. I don't care what excuses you try to use for that. And while a dividend can help balance that out a bit, Costco is only yielding about 0.5% right now because of how much the stock has climbed. So I'm sorry, Gemini, but I'm not giving you this point either. And finally, for other factors, the AI says respected management team, solid corporate governance, and high liquidity. All right, I'm sure management is doing a fine job because this is obviously a strong performing company, but I can't overlook the small growth with such a high valuation just because management has done a good job so far. Overall, I'm not a big fan of this one. I think it's okay, but I'd much rather buy something like Amazon stock or even, yeah, I would even say Walmart if I really wanted like a traditional brick and mortar retailer, which I really don't, by the way. I see way more potential in e-commerce. So Costco is going to get the number 4 ranking from me, at least for now until I see what else is on this list. Moving on to stock number 2 though, Gemini went with an even bigger giant, this time in tech, with Apple, ticker symbol AAPL, which is of course known for their large and very popular ecosystem of devices and services, with this stock also being one of the best performers in the market, having climbed by close to 1,000% over the past decade. And for financial strength, Gemini said immense profitability, reasonable debt, and consistently massive free cash flow. Which, yeah, of course, I agree with that. Apple is one of the largest and really best run companies in the entire world, doing almost 400 billion in sales with a very solid profit margin of more than 25%, which brings in over $100 billion of pure net income profit. Not to mention their massive pile of cash, which currently sits north of $160 billion as well. It's incredible, really. As for growth potential, though, it said, though recent growth may have slowed, Apple has high brand loyalty and potential in expanding services and wearables. They retain a significant competitive edge in design and integration, which, yeah, I mostly agree with this point too. Apple products and services have really always been praised for their high quality, which it better have for how expensive they are, but that's also led to a very loyal fan base with currently over 2 billion active devices out there in the wild, which they're also using to push out more service revenue that is higher margin, and that's very good for them. The result being that even though revenue growth is only a mid to low single digit, profit growth by EPS is actually in the double digits. And that massive cash pile I mentioned earlier should also help them invest into new growth areas as well, like, for example, foldable iPhones, which I really think will sell very well whenever they do finally release them. So although top line growth is a little small, I'm not really worried about it for their massive size. Margins are great, and I think Apple has a bright future in many areas. When it comes to valuation, though, I start to disagree with Gemini a bit, as it states similar to Microsoft, the PE isn't exceptionally low, but investors place faith in Apple's history of innovation and offers a reliable dividend, though with a lower yield. By the way, I'm guessing it's comparing it here to Microsoft just because they're the two largest companies right now at around a $3 trillion market cap each. But regardless, you're not getting away with this one, Gemini. The valuation here is very expensive, and there's no sugarcoating that when your PEG ratio is 46% higher than the sector. I mean, you could argue that it's worth ignoring, but it's definitely not a positive that you can brag about. And the dividend yield of only 0.5% isn't enough to make up for that either. But finally, Gemini mentions other factors, saying experienced management team and high liquidity, though some might feel a bit uneasy about a company as large and mature as Apple having further explosive growth potential. And okay, that's a pretty fair statement. Doesn't really add much to the conversation though, but I think overall Apple should get a number 3 ranking here because as much as I love it and am actually invested in it myself too, I just think that the valuation is too rich to get overly excited about where the stock trades today. So I'd rather be buying other stocks if I'm really looking for bigger opportunities. That will, however, bring us now though to stock number 3, which is actually a stock that I may have never even covered before on the channel. I don't really remember covering it, but it's a pretty interesting pick here by Gemini, and that is the sports apparel giant Nike, ticker symbol NKE, which of course has a very popular brand, especially with shoes and other apparel, and especially like sports apparel and gear and stuff like that, which they mostly sell either online or through their physical retail stores. Now, when it comes to the stock, it's actually had pretty weak performance in recent years, only climbing by about 22% over the past 5 years, while also falling by more than 40% recently from their highs. And Gemini had this to say about it. When mentioning financial strength, it said Nike has solid profitability, reasonable debt levels, and good free cash flow. Which, yeah, I think pretty lackluster statement there, but sure, I guess financials are solid enough as sales usually rise in most years, although profits have been a little stagnant for my taste, with the last reported year seeing their margins fall to just a single-digit percent. But the numbers are pretty large, so I'd still rate this category like a C+, maybe even a B if I'm being generous. As for growth potential though, Gemini said, revenue growth driven by brand strength, innovation, and direct-to-consumer expansion, benefits from fitness trends and international markets, which I think this one is a bit of a mixed bag here. On one hand, I do think that fitness trends will keep rising pretty much forever, especially with all the attention that it's getting right now on the internet and social media these days. It tends to be a very popular kind of trend. And I also agree with Gemini about international opportunities too, since Nike has done a great job of diversifying around the world, which even though North America is still their largest market at close to half their sales, they still have a growing presence in places like China, the rest of Asia, and also Latin America, where they can continue to expand. However, despite all that, sales are still only growing by a mid to low single-digit rate, with this year in particular expected to be almost flat. So, I don't really agree with Gemini on this category. Nike may be too large already in a highly saturated apparels market for us to really find much growth here. Let's see if we can at least get a good valuation for it though, where Gemini says, not cheap by traditional metrics, but investors have faith in Nike's brand power, reliable and increasing dividend payout. Yeah, I mean, you're not going to get away with this one either, Gemini. You can't sugarcoat a PE ratio of around 30 for a company that is barely growing like this, and especially for how much the stock has fallen recently. I mean, you'd think that the valuation would be dirt cheap here, but in fact, it's actually more than 70% higher than the sector. I don't care how strong your brand is, that valuation is very expensive, and a small dividend yielding less than 1.5% is not going to make up for that. But finally, we have other factors where Gemini says recognizable brand is a global competitive advantage, experienced management with high stock liquidity. Again, that may be all fine and good, but it's not enough to make up for the expensive price on such low growth. Nike is going to take the worst ranking from me at number 5. Alright guys, we're now down to the final 2 stocks of the list, and coming in at number 4, it's actually going to be one of my favorite stocks really ever. in the giant behemoth Microsoft, ticker symbol MSFT, which is, of course, a world leader in computer software and services with some impressive hardware stuff too. But overall, the stock has been one of the best performers in the market, rising by just about 1000% over the past 10 years, growing into what is now the most highly valued company in the entire world, at least a public one. And so when it comes to financial strength, Gemini says highly profitable with substantial EPS growth, manageable debt levels, and ample free cash flow provide flexibility and resilience. And yeah, Microsoft's financials are mind-blowing, guys, doing over $200 billion in sales last year with a whopping 34% profit margin that brought in over $72 billion of pure net income profit. It's absolutely incredible. As for growth potential, the model also says well positioned within expanding industries like cloud computing and gaming. Brand strength and productivity suite dominance add to its advantages. And yeah, I completely agree with this one too, although I am a little surprised that it didn't mention AI, since Microsoft has really now implemented it into practically every part of their business, and they were also the primary backer of OpenAI and ChatGPT, and they even launched new subscription services recently called Copilot, which should bring in higher recurring revenues over time as well, so they're all in on AI. But yeah, as far as the rest goes, I mean, you're talking Windows, Office, LinkedIn, GitHub, Teams, Xbox, with especially Game Pass, and also cloud in Microsoft Azure. These are all areas that Microsoft is pretty much dominating and will only grow larger with over time too. Again, this is a company that did over $200 billion in revenue last year, and yet it is somehow still expected to grow by a double-digit rate in each of the next 2 years. It's absolutely mind-blowing. Now, for valuation, Gemini says moderate PE reflecting solid performance, offers a reliable dividend with a history of increases. And this one is, I would say, a little more mixed. I don't think that there's anything moderate about a $3 trillion company, but to be fair, the PEG ratio is only 17% higher than the sector, which is actually not that horrible considering the insane quality that you get back in return. Microsoft has never been a cheap stock to begin with, and I think it's a perfect example of you really get what you pay for with this one. So while I don't consider this a value stock by any stretch of the imagination, it is still a much better kind of all-around package than most other stocks out there, at least in my opinion. Gemini did also mention the dividend, by the way, but while the growth metrics are excellent, the small yield of only less than 1% isn't likely going to be a major factor here. More of just like a nice little bonus for what is already a very high quality stock. But then finally, for other factors, Gemini says respected and experienced management team with strong shareholder focus, high stock liquidity. So pretty much the same kind of copy and paste statement that it's been using for every stock here. Although I will say that Microsoft does at least have Satya Nadella as the CEO, which many do feel is one of the best CEOs in the world right now. But regardless, I'm giving Microsoft the #1 ranking here. And I know I may sound a little biased here because it's already my largest stock in my own portfolio, but what can I say, guys? I like it at least a lot more than all the other options that we've seen so far on this list. And that's the honest truth. I just really like this stock, so I am giving it the #1 ranking. But we are now, however, down to the 5th and final stock. And this time, Gemini chose to go with a healthcare giant in United Health Group, ticker symbol UNH, which is the parent company of two healthcare leaders, those being Optum, which focuses on medical care, services, and technology, and United Healthcare, which focuses on health insurance. Now, the stock has also been a very strong performer over the years, climbing by close to 600% over the past decade alone. And Gemini had this to say about it. When talking about financial strength, it says, impressive EPS growth, healthy debt levels, and substantial free cash flow, which facilitates reinvestment. And yeah, UNH has been a beast when it comes to the massive healthcare market and what they're able to do there in terms of financials, nearly doubling its profits since 2019, growing from around 14 billion that year to over 22 billion last year. Sure, the profit margin is really small at just a mid-single digit percent, but when you're doing over $370 billion in sales, I mean, does it really even matter? I think their financials get at least a B plus rating, maybe even an A for that massive size. As far as growth goes, though, Gemini says, dominant force in health insurance and health services, benefits from a large customer base, and the potential for expansion in value-based care models. And yeah, once again, I agree with Gemini here. United is actually the #1 market share leader in America, and their Optum unit has really been innovating new technologies, even incorporating AI into much of it, which I do think can fuel even more growth for them in the future. Not to mention that the giant and aging baby boomer population will need more health coverage in the future too, with every baby boomer hitting at least 65 years of age by 2030, resulting in 1 out of every 5 US citizens being of retirement age, which I do think bodes very well for a healthcare leader like this. The only thing that kind of worries me about health insurers, though, is the recent push for free healthcare in America, which is part of the reason why I generally don't invest in them, because as a long-term minded investor, I'm just not really sure what the landscape is going to end up looking like many years from now. I'm not sure how it's all going to play out and how everything will work. But with revenue growth expected to be in the high single digits for their already massive size and an even higher double-digit rate for their EPS as well, yeah, I think they win this round here too. Moving on to valuation, though, Gemini says reasonable PE and PB ratios when considering its track record and market position, reliable and growing dividend payments. And yeah, I mostly agree with this one too. I do think the dividend is too low to really matter much, but it does at least have some excellent growth metrics on it. And the valuation is actually pretty damn cheap considering their size and dominance, with a PEG ratio that is 16% lower than the sector, if you can believe it, with the other metrics also looking pretty good too. And then I'm just going to skip this last part here though, because I'm kind of tired of Gemini repeating the same sentence for every company. But yeah, overall, this is a pretty good stock here, I would say. I just wish that I was maybe more knowledgeable about the healthcare market, or at least felt more confident about it long term. But I still think that it deserves at least the #3 ranking here. And I'm going to end up bumping Apple up one spot so that I can fit it in. But there you have it, guys. That's going to be my overall ranking. And overall, I would say that my general impression of all of this is that it was a very fun video to make for sure. But I do think that Gemini has a lot more work to do with its analysis capabilities, especially when it comes to stocks and also on that valuation metric. I kind of feel like Gemini was just ignoring some very rich valuations when analyzing these companies and just kind of focusing solely on how large and dominant these businesses are, which, don't get me wrong, that is very important for sure. But I think that if we were to ask it to put a little bit of a higher priority on the valuations, we would have probably gotten some more kind of overall, all around attractive stocks at today's prices, and it would have made for probably a better video. So maybe in the future we would do that. But like I said, it was still a lot of fun. And I'm actually thinking that it would be a cool idea to do another one of these videos, but maybe switch it up a bit and ask it for some dividend stocks, or maybe even like some innovative or disruptive companies. I think that would make for some really interesting stocks to look at too. So let me know if you guys would want to see something like that. But also let me know just what you think about all of this, and if you agree with my rankings, and if you agree with anything that Gemini said, or if you were more with me where you kind of felt like you were disagreeing with a lot of its points. But anyway, I hope that you enjoyed the video, and thank you so much for stopping by, my friends. If you want to support the channel, hit that like button, subscribe. There's also a link down in the description for Patreon if you want to support me that way too. It means the world to me, and thank you so much, guys, for all of that. But until next time, I'll catch you in the next video. Hope you're all doing well. Take care, everyone. Bye-bye.